Welcome to the Real Estate Espresso Podcast, your morning shot at what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about another missing piece in the puzzle over the evolution of money. Crypto-currencies were launched with the promise of replacing fiat currency with almost a crowdsourced, anti-establishment, off-grid vibe to it. The technology is rooted in the need for a system that would enable online microtransactions where the transaction cost could be virtually zero. If you want to make an online purchase, maybe, for example, within a game that costs only a few pennies or perhaps a few tenths of a penny, there's no payment processing system that caters to these microtransactions. By the time you've reached into your pocket and pulled out your credit card or your debit card, the transaction fees dominate. So there's no payment processing system that caters to these microtransactions. Some of the early movers were looking for a lightweight system that would make it possible to create a low overhead transaction. Rather than charge users for the transaction, they would require each computer to do a small amount of work. That work, in exchange for money, was called hash cash and would take the place of a centralized infrastructure required to process each transaction. After all, data centers are expensive to build and to maintain. They consume a lot of power and they require air conditioning. If instead of a data center you could harness the distributed computing power of all the users, you could get the work of managing and maintaining the database for free and require no data center at all. This concept was the early days of what later became known as mining for Bitcoin. If you could do a small amount of work and get some micro-financial credit for the work. Since the early days of Bitcoin, the notion of free work has been at the core of the distributed database, and it makes up the distributed blockchain. The agenda behind these technologies was simple and pure: create a low overhead financial transaction system. But later on, blockchain technologies took on the agenda of becoming a cryptocurrency. The notion of a store of value and an ever-increasing value, that came much later. It's this quality that's raised the ire of financial regulators. Governments really don't want competition for the nation's currency. The U.S. doesn't want it, China doesn't want it, and China has already outlawed cryptocurrencies. They've also issued their own central bank digital currency. So these technologies are under assault. But we're not talking about new legislation specifically targeting crypto technologies. The definition of a security is governed by the Securities Act of 1933 in the United States, together with all of the amendments and some of the precedent-setting legal cases. As soon as something fits the definition of a security, then it's subject to regulation by the securities regulator. In the U.S., that's the Securities and Exchange Commission at the federal level and each of the state's individual regulators. We've seen numerous cases where the regulators become involved. Some cryptocurrencies have been classified in the same manner as commodities, not as a security but as a commodity. And as a commodity, if the token falls under the control of the Commodities Futures Trading Commission, or the CFTC. As a real estate syndicator, I'm well versed in the requirement to comply with securities regulations. The second something is classified as a security, there's very strict requirements to follow. There's restrictions on advertising, requirements to disclose, and specific exemptions to comply with. The threshold for violating securities law is extremely sensitive. If you fail to disclose something required by securities regulations, you might be considered guilty of having committed securities fraud, exposing you to both civil and criminal liability. There's now a litany of celebrities who promoted FTX that are being charged with having violated securities laws. And U.S. regulators on Monday sued Binance Holdings, alleging the operator of the world's largest cryptocurrency exchange kept an illegal foothold in the American market, and they violated rules designed to prevent illicit financial activity. The lawsuit sets up a battle between the Commodity Futures Trading Commission, which is one of the U.S.'s smallest financial regulators, and a global company whose chief executive is one of the industry's most influential figures. Binance has survived and grown even as many other crypto companies have gone bankrupt over the past year. Now, the CTFC is a civil regulator, and it has the authority to obtain fines against people that break the rules. But its main enforcement hammer is the ability to seek orders that would permanently expel people from participating in U.S. derivatives markets or trading in cryptocurrencies that qualify as commodities, such as Bitcoin, Ethereum, and some stablecoins. And last week, the SEC issued an investor alert and bulletin. And in the bulletin, the SEC says those offering crypto asset investments or services may not be complying with applicable law, including federal securities laws. Under the federal securities laws, a company may not offer or sell securities unless the offering is registered with the SEC or an exemption to registration is available. One of the registration possibilities with the SEC is by an entity known as a broker-dealer and or an investment advisor. It provides important protections for investors. Some of those benefits include rules around custody of assets, fees, conflict of interest, standards of conduct, and minimal capital requirements for broker-dealers. But this is an exemption from registration. You're not exempt from following the rules associated with a specific exemption. The way it looks to me is that the federal government is attempting to poison the water for those hoping to use crypto as an alternative to actual U.S. dollars. In my view, the additional regulatory burden is going to cause a lot of the current players to exit the space entirely, and the notion of using crypto as a place to park cash is highly flawed in my opinion. The SEC makes reference to the many risks to investors associated with crypto. These risks are not hypothetical or academic. The SEC may in large part be the cause of those risks to investors directly. We don't even need to talk about the entire FTX fiasco. Apart from the fact that the principals at FTX appear to have committed outright fraud and embezzlement, they're also being charged with a litany of securities violations, and so too are the many celebrities who promoted FTX. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.